All right, let's get right into it. Today, we're going to pull back the curtain on the financial markets. We're going to decode what looks like pure chaos and reveal a hidden, almost predictable code that drives price delivery. Welcome to AI Explains ICT. In this video, we are digging deep into some really powerful ideas from ICT's core content, specifically Month 5, Episode 1. Honestly, there's a lot of incredible detail here, so you might want to grab a pen and paper. You're probably going to want to take some notes. So let's start with a really big question, one that kind of underpins everything. We're always told the markets are random, right? That they're just this chaotic mix of news, fear, and greed. But what if that's not the whole picture? What if there's a script that price is actually following? And this right here, this is the core idea from ICT that changes everything. The belief that markets aren't random at all, but that they are 100% engineered, that every move is controlled, it's precise, and it's methodical. Now, if that's true, it means we can stop guessing and start learning how to read the actual blueprint.
So here's our game plan for today. We're going to start with the theory, the hidden engine of the market and its natural rhythm. Then we'll get into how to track what smart money is doing. And after that, we get really practical with something called the look back and cast forward methods. And we'll tie it all together with a real-world forecast.
So, what is this hidden engine driving the market? Well, according to ICT, it's an algorithm, a very specific one called IPDA. IPDA, it stands for the Interbank Price Delivery Algorithm. Just think of it like this. It's an automated price engine running at the highest level, the central bank level. And its job isn't to be random. Its job is to deliver price efficiently to very specific levels. It's always reaching for liquidity, the pools of orders resting above old highs and below old lows. The key here is that it operates within very specific, predefined data ranges, and that is what allows us to start forecasting where it's going next.
Okay, so if this engine exists, it has to have some kind of schedule, right? A rhythm. And that brings us to the market's pulse, the concept of quarterly shifts.
The market really does have a pulse. It's almost like clockwork. About every 3 to 4 months, you'll see a major shift in direction or feeling across the board. And this applies to all asset classes. These aren't just random wiggles on a chart. They're engineered events. Sometimes it's a really deep pullback in a trend, or maybe a long, drawn-out period of consolidation. Either way, they're designed to shake things up and trap people on the wrong side of the market. Understanding this rhythm is step one to seeing those big turning points before they happen.
And you can literally see it right here. This is a daily chart of the dollar index. Those vertical lines, they mark off those quarterly periods. Just look at how the price action completely changes character between those lines. You see these very distinct swings and changes in direction that line up perfectly with this cycle. It's not random at all. It's structured.
Okay, so if the market is engineered and it has a rhythm, who's the engineer? Well, it's what we call smart money. And the best part is they leave footprints. We can actually track what they're doing by looking at the relationship between different but related markets.
This table here shows us exactly how to spot when smart money is buying or accumulating. So in that first scenario, let's say your benchmark index makes a new low, but the asset you're watching makes a higher low. That's a huge tell. It's showing relative strength. It means the big institutions are in there, propping it up. Or look at scenario 2, where your asset dips to a new low but the benchmark doesn't. That's often a sneaky move to grab all the sell orders before price shoots up. Each of these scenarios is a clue that the big players are quietly loading up.
And of course, the same logic works in reverse when we're looking for distribution or selling. So in scenario 1, the benchmark pushes up to a new high, but our asset can't, it makes a lower high. That's a classic sign of weakness, showing that there's heavy selling pressure. Then in scenario 2, you see the opposite of that liquidity grab we just talked about. Your asset pokes up to a new high while the benchmark doesn't. That's a classic move to hunt all the buy stops just before a big drop. These little mismatches, these divergences, are how we can start to see what the institutions are really doing.
All right, enough theory for a minute. Let's get practical. How do we actually put this stuff into a framework we can use over and over again? Well, it all starts with a process called the look back, where we scan the past to find clues about what the institutions are planning.
It's a really systematic process, super simple. First, you set your anchor. Just drop a vertical line on the very first trading day of the last month that just finished. Easy enough. From that line, you're going to measure back in time. 20 trading days, 40 trading days, and 60 trading days. Now, inside that window of roughly 2 to 3 months, you're looking for just two things. One, what was the general order flow? Were they buying or selling? And two, where are the obvious pools of liquidity? The old highs and lows that the algorithm might want to target.
And here's what that actually looks like on a chart. You can see our anchor point, and then we've marked off those 20, 40, and 60-day look-back periods. This isn't about some magic indicator, okay? It's about defining the exact data range that the algorithm is using for its calculations. When we look back inside this specific window, we get the context we need to figure out what's likely to happen next.
So, once we've studied the past, we can use that exact same logic to project into the future. This is the next piece of the puzzle, the cast forward, and it helps us build a time frame for our forecast.
The process here is just beautiful in its simplicity. You start from the exact same anchor point we used for the look back, but instead of looking left on your chart, you just project those same time intervals, 20, 40, and 60 trading days, to the right, into the future. What this does is it creates a high probability time window. We are literally forecasting when the next big quarterly shift or major price swing is most likely to kick off.
And here it is on the chart. We've taken those same time intervals and just projected them forward from our anchor. Now we have a target, but it's a target in time. We're not just guessing that the market might turn sometime soon. No. We have a specific 20 to 60 trading day window where we should be on high alert for a big reversal or a major continuation setup.
Okay, now for the really fun part. Let's put all of these pieces together. We're going to take IPDA, the smart money analysis, the look back, and the cast forward, and see how they work together in a real-world example to pinpoint a precise market move.
Okay, so let's break this down. On the left, we've got our benchmark, the dollar index, and it's clearly making higher highs. Now, if the dollar is getting stronger, you'd expect the euro on the right to be making lower lows, right? But look, it's not. It's making higher lows. That is the classic smart money accumulation signal we just talked about. It's telling us the dollar's strength is probably fake and the big institutions are quietly buying up the euro, refusing to let it drop any further.
And here's the payoff. After we spotted that smart money was buying, the euro took off on a huge rally. But where did it stop? I mean, look at this. The absolute high of that entire move formed on the exact day that marks the end of our 60-day cast-forward data range. It's incredible. This is the power you get when you combine price analysis with time analysis. We had a reason to be bullish, and we had a precise time window for when that bullish move was likely to end.
So, let's wrap this all up. What are the big takeaways? First, the market isn't random, it's engineered, and it runs on a predictable quarterly rhythm. Second, we can actually see the engineers, the smart money, at work by looking for those divergences. And finally, and maybe most importantly, the look-back and cast-forward methods give us a real framework to forecast not just what might happen, but when it's likely to happen.
And that kind of brings me to a final thought for you to chew on. If price delivery really has this level of structure, this level of predictability, it completely flips the conventional view of the markets on its head. So my question to you is, how might this change the way you approach your own analysis?
Hey, if you found this breakdown useful, do me a favor and hit the like button and subscribe to the channel for more deep dives like this. And if you have any questions at all, just drop them in the comments below. A real person will get back to you, I promise. Until next time, everyone, safe trading.